So today we're also going to talk about Section 1031 exchanges. Now, this is a question I get all the time from my real estate investor. Can I do a Section 1031 exchange? So first I'll explain to you guys what a Section 1031 exchange is. A 1031 exchange allows an investor to reinvest the money into a like-kind asset without owing tax on the gain at that point. Does not mean it is a tax-free event. It is a deferred tax event. So it is important for you to understand that a 1031 exchange does not help you to get away from paying your taxes. It just defers your taxes. Whether you should be doing this or not is always questionable. You should always talk to your CPA about this part, because sometimes it makes sense to do this and sometimes it doesn't. So you definitely need to do a projection on whether this makes sense. Also, there are very, very strict rules on Section 1031. IRS plays no joke with this one. So the process involves a third-party intermediary that receives the proceeds from the sale of and handles the purchase of the replacement property. So a Section 1031 exchange is the sale of one property and the buying of a like-kind property to replace the sale of the first property. It has to be like-kind, and there are rules behind what like-kind is, which is not something that this short video can give you. I can give you that information right now, but there are rules about what like-kind is. You need to understand what like-kind is. An investor is a property is considered an investment property. So you always have to think this is a business deal. It's an investment property that you're exchanging. What kind of investment property and what is the definition of like-kind, you also need to understand. These transactions have very strict deadline. They require that you identify your replacement property within 45 days and complete the acquisition within 180 days. And they are very, very strict on these rules, because if you don't follow these rules, you can pierce the veil on the 1031 exchange and it can become invalid. So it's definitely really important for you to understand what the rules are, understand what like-kind property is, and whether you should be exchanging these properties through a 1031 or not. Also, if these deadlines aren't met, the full amount can be considered taxable. When these proceeds are left unreinvested, this is known as boot. Boot means cash. Boot amount is taxable, while the rest of the gains can be deferred until the replacement property is sold. So it is a complicated thing. I know a lot of noise is made out there about Section 1031 exchanges, but you really need to speak to your CPA, speak to an intermediary, understand what it really is. Not even all CPAs understand Section 1031. They need to probably refer you to an intermediary to understand what a Section 1031 exchange is, and if you do qualify to do that. I know it is appealing to a lot of investors, and they want to push it on you a lot of times, but you have to understand if you qualify first, what the qualifications are, what the parameters are within being qualified for it. So, you need to think about it. Is the sale in a future year of your taxable income lower? So you need to think about it. Am I paying a low tax rate right now? Am I going to be paying low tax rate later? Because you are deferring the tax on the property. You're deferring it from one property to another. So you need to decide, first of all, how much is your capital gains that you're going to be deferring, what the capital gains tax on that property is that you're going to be deferring. So how much tax are you deferring at that point? And is it worth doing? So, the taxable income into multiple pieces, which may allow you, the seller, to pay a lower tax rate and avoid them altogether, depending on your taxable income that year. So it depends on a lot of things, and you have to weigh all your pros and cons before you decide on a 1031 exchange. You also have to remember that there is a cost for an intermediary to handle your exchange. So there is a cost. You need to make sure that you understand what the cost is. So what assets would I kind of recommend blanketly for a Section 1031 exchange? Let's say you've owned a property for over 30 years and you are going to be making $5 million on it, and it's all long-term capital gains, and I'm making that up. So 20% of the $5 million will be basically what your tax is. Then in that type of a situation, it might be worth it to pay an intermediary a few $1,000s to do this and defer your tax to the next property if it all makes sense to do that. Let's say there's a different scenario and you have a piece of land that you've owned for, I don't know, maybe let's say you own it for 5 years and you bought it for $200,000, and now you're ready to sell the land and you're going to sell it for $300,000. So you're going to make $100,000 on this property. So your tax is going to be $20,000. Now, what does the intermediary charge you? So you need to understand what is the cost of the intermediary. Are you going to be able to follow the strict deadlines in the numbers, in the timeline, the strict timeline deadlines for the exchange and all those things? Because your tax is $20,000. Do you want to just defer $20,000 because you're going to be paying for the intermediary? You're going to have to follow the strict deadlines. Is it worth it to defer the $20,000? Because do you know for sure that your tax rate is going to be lower next for $20,000? Those are all the things that you need to be thinking about. You need to be asking yourself. You need to contact the intermediary, and you need to talk to your CPA, your trusted advisor. Definitely talk to them about doing a 1031 if you are interested in doing a 1031. So stop listening to the noise about 1031 and really understand it before you're thinking about it. So that's my story on 1031s. There's a lot more that we can talk about it, but for today, that is it in a nutshell.